Hey everyone, welcome back to Corporate Decoder. Today, Dollar General Corp DG just filed their quarterly report for the period ending May 1st, 2026, and I am seeing a story of solid growth but with some interesting pressures to watch. Quick note, this is not financial advice, just my take on public filings for educational purposes. Dollar General is growing its sales and profits, but the cost of doing business is also creeping up, and they are heavily leaning on their core customers' resilience to navigate these challenges. Alright, let's dive into this report. It gives us a snapshot of Dollar General's financial health as of May 1st, 2026. Looking at their balance sheet, we see assets totaling over $31 billion. That is a jump from over $30 billion in January of 2026. A big chunk of that is merchandise inventories, which are at $6.6 billion compared to $6.3 billion previously. This tells us they are stocking up on goods. On the other side of the coin, liabilities are also up to nearly $22.9 billion from about $22.5 billion. Most of this is current liabilities like accounts payable, which are at $4.3 billion. Shareholders' equity stands at almost $8.9 billion. Now let's talk about what really matters: income. For the 13 weeks ending May 1st, 2026, Dollar General reported net sales of over $10.7 billion. That is a nice increase from about $10.4 billion in the same period last year. Gross profit is up at $3.4 billion compared to $3.2 billion. This means they are making more money on the products they sell. The gross profit rate actually improved to 31.6% from 30.9%. This is a good sign, indicating better pricing strategies or more efficient cost of goods sold. However, their selling, general and administrative expenses also increased to $2.7 billion from $2.6 billion. As a percentage of sales, these expenses went up slightly, which means the cost of running the stores and operations is inching higher. All in all, operating profit saw a healthy jump to $638.5 million compared to $576.1 million last year. That is a 10.8% increase, indicating that despite rising costs, the company is managing its operations well. And the bottom line net income rose to $444.1 million from $391.9 million. That is a solid 13.3% increase, translating to $2.02 per S-share on a basic and $2 even per S-share on a diluted basis. This is a significant improvement from last year's $1.78 per share. Comprehensive income also saw a positive trend, growing to $443.9 million. Looking at shareholders' equity, retained earnings have grown substantially to over $4.7 billion. This shows the company is reinvesting profits back into the business or has a strong history of profitability. In terms of cash flow, Dollar General generated $716.1 million from operations in the first quarter of 2026. This is a bit lower than the $847.1 million from the same period in 2025, primarily because inventory levels increased significantly. Investing activities show significant spending on property and equipment at $351.6 million compared to $290.9 million last year. This indicates ongoing investment in store remodels, new store openings, and technology. Financing activities saw a significant decrease in cash outflows to $153.7 million from $639.3 million. This is mainly due to lower debt repayments compared to the previous year. The notes to the financials give us more detail. For example, they mention that the company uses the last in, first out, or LIFO method for valuing inventory, which can affect reported costs. They also highlight supply chain finance programs, allowing suppliers to sell payment obligations to third parties. The earnings per S-share calculation confirms that improved net income led to higher earnings per S-share. For the 13 weeks ending May 1st, 2026, diluted earnings per S-share was $2, and this is up from $1.78 in the prior year period. Income tax expense was $147.2 million this year compared to $119.6 million last year. The effective tax rate increased to 24.9% from 23.4%, mainly due to expired federal tax credits. Dollar General operates primarily on leases for its stores and distribution centers. They have significant operating lease assets and liabilities reflecting this strategy. Looking at their debt, they have about $4.5 billion in long-term obligations. They also have a revolving credit facility and a commercial paper program. But importantly, they had no outstanding borrowings under these as of May 1st, 2026. This suggests strong liquidity. The company's liabilities measured at fair value are primarily their debt instruments and are mostly classified under Level 1. meaning their value is based on quoted prices in active markets. Their total debt valued at fair value is over $4.4 billion. This section details legal matters. There is ongoing shareholder litigation concerning alleged misrepresentations about store labor inventory and pricing practices. While the outcome is uncertain, they state that any resolution could materially affect their financial statements. This is a key risk to monitor for shareholders. Dollar General reports as a single operating segment. Sales are broken down by product category, with consumables making up the largest portion, about 82.5% of net sales, followed by seasonal home products and apparel. Consumables saw a 3% sales increase, while seasonal and apparel categories showed stronger growth of 6% and 6.7% respectively. The company has a substantial share repurchase program authorized, but they did not repurchase any shares in the reported quarters. They did, however, continue to pay dividends at 59 cents per share. The independent auditors conducted a review and found no material modifications needed to the interim financial statements. They also confirmed the balance sheet presentation from the audited annual report is fairly stated. Now, from management's perspective, Dollar General highlights its position as the largest discount retailer by store count, operating over 21,000 stores. They focus on serving value-conscious customers who are sensitive to economic factors like inflation and government assistance programs. This statement really underlines the sensitivity of their customer base to economic shifts. They are seeing increased expenses like fuel and higher product costs, which they expect to continue pressuring customers' spending. Liquidity seems solid for now, with strong operating cash flow and available credit lines. Same, store sales are up 2%, which is positive. This growth is driven by a 1.4% increase in customer traffic and a 0.5% increase in average transaction amount. The higher transaction amount is likely due to increased prices. Average sales per square foot also improved to $271 from $265. This shows they are getting more sales out of their existing store space. Inventory turnover remains stable at 4.5 times, similar to last year's 4.2 times. This suggests they are managing their inventory efficiently. Digging into the results for the quarter, net sales increased 3.4%. This growth is mainly from new stores and that solid same-store sales increase. Gross profit dollars rose by 5.5%, and importantly, the gross profit rate improved by 65 basis points. This is attributed to better inventory markups, lower shrink and damages. SG&A as a percentage of sales did tick up slightly by 25 basis points, mainly due to higher depreciation, utilities and property taxes. Interest expense decreased significantly by 26.9%. This is a positive sign, likely due to lower average debt balances. The income tax rate increased slightly due to expired tax credits. The company highlights that inventory is a major asset, about 44% of their total assets. Effective inventory management is key to their cash flow. They also acknowledge that legal matters could potentially lead to material cash payments. This note about borrowing availability being limited by CP notes is a bit technical, but essentially they are maintaining flexibility. Cash from operations decreased, mainly because of higher inventory levels and the timing of payments to suppliers. Even though total inventory is up, per store inventory is down a little, which is a positive. Investment in existing stores for improvements and remodels is up to $202.8 million from $166.7 million, showing a commitment to refresh their store footprint. They plan to spend between $1.4 billion and $1.5 billion on capital projects this year, including new stores and remodels. Dividend payments remain consistent. They have a large share buyback authorization, but haven't used it recently to preserve their credit rating. This is something to watch, as they might resume buybacks in the future. No significant changes in market risk disclosures. They are implementing a new enterprise resource planning system, which is a big undertaking that could impact financial reporting. The legal proceedings section reiterates the ongoing shareholder lawsuits concerning disclosures about business practices. No new risk factors beyond what is already discussed in management's overview. No new insider trading arrangements were adopted or terminated this quarter. And finally, we see exhibits including award agreements for directors and employees. So what is the big picture here? Dollar General is growing its sales and boosting its profits. They are reinvesting heavily in their stores and infrastructure. The economic headwinds are real for their core customers, and that is reflected in some increased operating costs and inventory build. But the company appears to be navigating these challenges effectively for now, with solid liquidity and improved gross margins. The ongoing legal battles are a lingering risk, and the increasing cost of doing business is something to keep an eye on. What I am really looking for next is how they manage those increasing operational costs against their customers' price sensitivity. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.